Jer, this is the video that I said is gonna give you um, the same for your auditing and accounting, actually FRK and auditing. And it's gonna be a bit of a long one. Hopefully I can get it in under 30 minutes because I'm gonna be hitting both accounting and auditing at the same time. And there's a rationale to that. Um, yeah, so that's gonna be that. I'm just gonna project your study guide so that I can speak from there. And hopefully, some of these things that I'm speaking of, because you've gone through the year, because you've gone up through it up to now, they should be familiar. I'll try and make notes on my side um, to share with you when I do see you. Otherwise, even if I don't give you the notes, hopefully this can give you a comfortable enough overview that you're able to practice this, right? First of all, especially at university level, right? I can 100% guarantee you that auditing is actually auditing accounting. In real life, in inverted commas, so in practice, let me not say in real life, in practice, we audit everything. In financial management, you can audit a tax statement, you name it. So the good news about auditing itself is that the reason why you are going through this process now, so this process of introduction to audit planning, audit strategy, and planning material, is so that we can teach you the language as well as the steps that we follow when we audit, right? That's all that we're trying to do. Auditing is a tool for all the other subjects. So, honestly speaking, or theoretically speaking, you can't study auditing itself. You actually have to know accounting very well, tax very well, and financial management very well for you to do well in auditing. The only way that we assess auditing as a separate topic is when we're testing your use of the language that we use when we are reporting on what we have just audited, which is accounting in your case, but financial management and tax for professional purposes. So auditing is a tool. Auditing is not a subject per se that you have to cram. Like, for example, if I give you a couch and I say to you, account for this couch, I effectively am taking you to accounting. This is IS 16, this is property, plant, and equipment, and you follow the recognition criteria and what have you. What auditing does is that it says, now here's a set of tools, go and check if they did that particular thing that they said, that we know, not even that they said, that we know they have to do in accounting, that we know they have to do in tax, that we know they have to do in financial management. But you can never audit auditing. Auditing by itself, you can never really do. And it will make sense by the end of this video. So I urge you with my whole heart, and it's not by mistake that they made sure that you're writing accounting as your first paper on the 14th of June, and then you write auditing only on the 21st of June. So the way you are going to study for auditing is, first of all, you will have done this that I told you about when it comes to your graded questions and perusing your script. But what this video is going to show you is that this is what you actually are supposed to have taken out of that exercise. And this is why I said you can even come back to this video just before your auditing exam, just to make sure that you and I are on the same page and you have studied exactly the way and the things that I said you should understand. So understanding that auditing is a tool that helps us to check if our clients are reporting financial statements that do not have misstatements. That is the aim of auditing. So I'm going to write that first and foremost. The objective of auditing, and you'll see in the definition, the definition of auditing is a system designed, wara, those long things, and it says to ensure three things: to ensure the efficient operation of controls, to ensure the reasonable reporting of financial statements, as well as the last one, compliance with laws and regulations. That is the definition and the objective of auditing. And the end of auditing, what we do when we are finished auditing, we express an opinion. What is that opinion? We say these financial statements are good or bad. That is absolutely all that you are doing in auditing. You can stop the video now. Literally, that is all that we're doing in auditing. So the reason we started with the regulatory environment and King and CPC and whatever, because those are tools. That is the language. A business is held under Companies Act. For you to come and say this set of financial statements, let me show you, I've got a set of financial statements here for a client that I'm working on. This set of financial statements, the whole point of auditing is so that at the end of this document, I can say to the readers of the financial statements that I, as the auditor, am happy with these financial statements. And therefore, anybody that picks them up and makes decisions using them can rely on them, because I, as the auditor, have gone through the steps to make sure that those numbers are free from material misstatements. And you can already hear that I'm using the language. That is what auditing is doing. In an ideal world, we wouldn't have auditors. We would just have management that prepares financial statements. When they finish, they publish the financial statements. What happens to those published financial statements? Banks take them and they decide whether they should borrow you money or not. What happens to those financial statements? Chairman Mo, investors take those financial statements and they determine if this company is a good investment or not. Some employees and trade unions take these financial statements and see, are we being paid fairly? Is the company going to exist next year? So can I take out a bond on my house because my job is safe? And this comes from where? IAS 1. What's that? The objective of financial statements. What does IAS 1 say is the objective of financial statements? You know this, to enable users to make economic decisions. IAS 1 says financial statements should be prepared so that users of financial statements can make economic decisions. In an ideal world, we would not have auditors. Management would compile the financial statements, publish it, and then we would read it and make these decisions. As I said, as an investor, the decision to buy shares. As the bank, the decision to extend credit. As an employee, whether I should take out a bond or not. As a trade union, whether I should strike because the CEO's salary is too high or not. But because we don't live in a perfect world, auditing comes in. And we now say, we are going to appoint you, Junior, to go through these financial statements, as well as the supporting documentation. Let me get supporting documentation. As well as the supporting documentation. I think I should even take off, what's this, my back screen, so that you can see these statements correctly. I'm gonna put none. Yes, there we go. Right, for illustrative purposes. So we say take these financial statements. Do you see how thin they are? Take this supporting documentation. Do you see how much it is? Because these are all the invoices. These are all the receipts. These are all the lease contracts that we get for rentals. Every time we buy something, we get a receipt. Every time we pay for something or we get paid, we issue a receipt, we issue an invoice, and we end up with these financial statements. And you will remember from Accounting 101, what is bookkeeping and journals and ledgers and trial balances? It's summarizing financial transactions into a readable format, into a format where someone can just look at the income statement or the statement of financial performance and say, after all of these transactions have been summarized, this is what the performance of the company looks like. After all of these assets that were bought and leases that were entered into, this is what the balance sheet looks like. After all of these bank statements, let me get bank statements. After all of these bank statements for the 12 months, this is what the statement of cash flows looks like. In here, this is what the statement of cash flows looks like. So auditing is that tool that says, okay, oh my God, how am I gonna do all of this work by myself? Well, the definition of auditing first says we're gonna be systematic. It's a systematic way of doing that. And the first thing that you're gonna see after your laws and regulations and Companies Act is this: audit planning, audit strategy, audit planning materiality. Why? So I will start with planning materiality. Remember, we said IAS 1 says the objectives of financial statements is to enable users of these financial statements to make economic decisions. And in accounting, that is where, when you remember your conceptual framework, one of the considerations was the concept of cost-benefit analysis. And sometimes in auditing, we call that one of the limitations of AFS. And under cost-benefit, your IFRS standards say to you that management needs to make decisions about what amounts are relevant to the users of financial statements. And auditing starts at exactly the same place. It says, let me start with materiality. Let me calculate what is the amount that when we are going to perform our audit procedures, when we're going to look at these invoices, what happens when I find a 10 Rand invoice? Ignore it. Why? Because 10 Rand is not a big number. It's not going to change the decision, the economic decision of the user. But what about if I find a 1,000,000 Rand invoice? Oh, that is definitely material. That needs to be inside the financial statements. And auditing already at the very beginning says, for you to audit, you firstly need to have some concept or some appreciation of which invoices, which transactions in the general ledger are going to be material or significant for me to look at. And the reason why is because at the end of the process, you are going to express an opinion that says the financial statements are free from material misstatement. They are fairly presented, as accounting calls it. But because we are auditing then reports it in the negative. It says they are free from material misstatements, meaning that after we have determined a materiality figure and we've looked at everything that is bigger than materiality and we have found no errors, we can say these financial statements are free from material misstatements. There might be an error that is less than materiality, but that's fine because the very calculation of materiality sets a bar to say everything smaller than this is unlikely to make the news tomorrow. It's unlikely to be so significant that the user of the financial statements finding out that that invoice was not included in the financial statements, they will then say this is a bad company. So that is why we start with materiality, planning materiality. That is what materiality is for. And now you explain yourself. This is where your marks come in. You explain that materiality is a subjective exercise. You get a mark in your exam for saying that. And then you explain that having looked at the background to the case study, this company is asset heavy. So what are we talking about? If we're dealing with a construction company, if we're dealing with a property company, then you know that the materiality figure is going to have to come from assets in the balance sheet. And that is where they gave you all those numbers, where they say you either use revenue, in public sector we use expenditure, and we use assets. And they gave you that 1% range. And they say everything that is bigger than 1% of revenue is material. Everything that is bigger than 0.5% of expenses is material. Anything that is bigger than 5 to 10% of assets is material. And while you're explaining this, you are getting marks for that explanation. But at the same time, while you are doing that, you are showing an understanding for accounting. You are showing that you understand that this company has a lot of PPE, which is why I said to you, it was smart of them to put your accounting test first. Because if you write on PPE, if you have a case study, if you have a, what do you guys call it, in your year test, if your scenario, as you are reading it, you can see, oh, IS 16, IS 40, IS 36, impairment, IS 38, intangible assets, all of those things. And you see that, this case study has a lot of assets in it. Already, you can revise your auditing right there and there on the spot and say, materiality is a subjective exercise. Use a different color pen, a green pen, and say, if I were to audit this company, I immediately would have said the most relevant item to use to calculate materiality is assets. And the reason we use assets is because this company is asset heavy. And why? Because you're doing an accounting case study, and most of your accounting, I think in second year and third year, you do assets up to your neck in assets. It leases, it's property, plant, and equipment, it's inventory. Remember inventory from first year? It's inventory, it's IS 40, it's impairment, it's contingent liabilities, it's provisions, it's this, it's that, it's oh my God. You can already write your auditing to say, how would I audit this? And I'm going to teach you the language. For accounting, you master your standards. You master your standards. And as you're reading your auditing scenario, there was a fire at the warehouse, PPE impaired. I must remember that. Microsoft is a software development company. In auditing, you note that, oh, if this was accounting, already I know we've got intangible assets. Right? So that is planned materiality. That now gives you something that you can walk in and you say, in this company, every transaction, in fact, in the olden days, the way they would do it is they would say to the CFO, listen, Chief Financial Officer, give me every invoice that is more than 10,000 Rand and put it here in front of me. And how would you have done that? You would have looked at the financial statements. You would have seen that revenue is my significant item. Revenue is 1 million. 1% of 1 million is 10,000 Rand. Therefore, if any invoice of more than 10,000 Rand is not recorded in our books, then revenue is not fairly presented. We can already start writing the audit opinion now. That is auditing. But because we've moved from the olden days, and you cannot just come in and say, give me all your documentation. We then have to do thorough audit planning and an audit strategy. Now, what are the difference between audit strategy and audit planning? Well, the first thing is audit strategy is going to come from your risk assessment at overall financial statement level. When you do that exercise of should we accept this client or not, can they pay our audit fee? Does management have integrity? All of those things, that affects your audit strategy. Why does it affect your audit strategy? Remember I said to you that I can already give you the audit strategy responses or the risks at overall financial statements. I can already tell you now, at overall financial statement level, the only responses that you can ever do is get more experienced staff members. The only response you can give to risks at overall financial statement level is select specific items for testing. Have regular reviews. Reviews of what? Reviews of your audit team. When a first year says, I have audited inventory, review it. Because you want to make sure that no mistakes were made in the audit so that we can end up expressing an opinion. And that is why they say, what is audit risk? The first question that you got in question in audit risk is the risk that we express the incorrect opinion. What does that mean? So the financial statements don't have an invoice that is, or they have an invoice of 10,000 Rand missing. And then we say that no, the audit is clean. There has been no problem. That is an incorrect statement because the audit is not clean. The financial statements are not free from material misstatement. They are not fairly presented. There's 10,000 Rand missing inside the financial statements that should have been recorded, that the auditor found wasn't recorded. And there's 4 others. You will see them. They should ring a bell by now. But those are the responses at overall financial statement level. There's nothing else you can do. There's about 7 or 8 of them. There is nothing else you can do. In an exam, when they say to you, how do you respond to the risks at overall financial statement level? You immediately write this 8 down, 8 marks in the bag. So we're still at audit strategy. And that's why I say audit strategy then says, after having looked at this environment, we are going to hire better staff. We are going to hire. So it's the overall things that you're going to do. We are going to have regular reviews. We are going to select specific items for testing. We are going to increase or decrease our materiality. And where does that come from? It comes from that understanding that you have of the entity, which is why for after your first CV exam, the first thing that you wrote about was risk assessment procedures, fraud and error. But so that I don't cheat you, let me continue. Audit planning. Audit planning, once you understand the rest of the audit process, it will make more sense. But audit planning now goes even further into detail. Audit planning says, when I read this case study, I can see that no, really, there is an impairment problem. This comes from accounting, by the way. IS 36, there's an impairment problem. Impairment is going to be difficult here. Calculating value in use, fair value to sell. As a result, in your audit planning, so in your audit strategy, you would have gotten a more experienced staff member. In your audit planning, now you're going to explain what must this audit more experienced staff member do. Now that's your audit plan. And you will say that this staff member, and now you do nature, timing, and extent. This staff member must do substantive procedures, i.e., they must pick invoice after invoice after invoice and make sure that the carrying amount of property is correct. Then they must obtain the valuation report. We are still under nature. Substantive procedures. Timing. Under timing, you say, because it is such a high risk audit, the staff member must preferably be there first thing when we are able to obtain the financial statements, and they must stay there throughout the audit. In fact, they must do an interim audit. And then if interim audit goes well, we can roll forward. And at year end, we just need to make sure that from interim to year end, we just audit that part instead of coming once at year end and doing the whole year's transaction. Why? Because this is a risky item. And we're gonna go to risk now. Now, even the language that I'm using, you can hear why so many tests and so many marks had to do with risk of material misstatement, or at least your CV2, and you see now your year test 2, because that's where we're going towards, that risk of assessment, risk of material misstatement. That's where it's coming from. And that's your audit plan. And then extent is sample sizes. Again, it becomes difficult if you haven't done this in practice, but for you, where it's gonna become easy is because I'm telling you this, and you're gonna see that, you know what, for how difficult that impairment question is, I would actually say, when we say extent, I would say select a higher sample size. Extent says, okay, instead of looking at 5 revenue invoices, let me look at 100, because this item is so risky that I would like to actually look at more and more and more and more invoices. And what am I doing when I'm looking at those more invoices? I'm doing substantive procedures, which is nature. I'm doing this at interim, which is timing. And I'm doing 100, which is extent. What happens with something like a building, office building, if we are not a property company? First, sit back and think, how often does this transaction happen? It happens once in 20 years. There is no way there is a high risk. What, we're gonna buy the wrong office building? So accidentally buy a building in Midrand when we wanted to stay in Sandton? That is very unlikely. So what is the nature of the audit procedures that you're gonna do there? There, you're not going to do substantive procedures. You're not going to select every invoice because there's only one invoice for the property. There, you're just going to do test of controls. Why test of controls? Because there, you know that the only thing that can go wrong with the mid-rank building is that we forget to sign the lease agreement or the purchase item on the day that we are supposed to move in. So for accounting purposes, if the year end is 31 December, what happens in December? What happens in December? Offices close on the 16th of December. Remember, people go home, and when do they come back? On the 4th of January. Now we're auditing this company with a 31 December year end. They've reported that in this current financial year, they bought an office building worth of 5 million. Remember, they're going to take these financial statements and go to the bank with them and show the bank that, look, we've got assets worth of 5 million, therefore borrow us 2 million based on our assets. So what are they going to do? 16 December, they have an office party. The young man from the bank comes running and he says, here's your, what do you call this? Here's your certificate, your bank certificate, or your title deed for the office building. And what does the CEO say? Come back next year. We are at our office party. We'll see that next year. Inventory. On the 16th of December, they come to deliver inventory. What do the people that work at the collection point do? We'll collect it next year. Or they sign for it and then put it there, and then they don't count it. They go. Obvious, the warehouse is gonna be locked. So next year, will count it on the 4th of January? And so timing becomes important. When do we do this procedure? Or when we inspect the control and we're looking for the signature and the date. Inspect the title deed for the signature of the receiving clerk, as well as the date to confirm that it was received before the 31st of December. If it says 4th of January, you know it shouldn't be in this year's financial statements. It should be next year's financial statements. Unless subsequent events, IAS 10 comes in. But do you see how accounting is informing what am I doing? And that's the audit planning that you're gonna do. So that's audit planning, that's audit strategy, and that's planning materiality. That's what they mean, and that's how they come in. Your CV1, you wrote about it. I saw you passed. It means you're comfortable with it. Just make sure you polish it, because for year test 2, it's just going to keep on coming back because it builds on top of each other. You are now writing for your degree. I don't have to tell you. You know this, right? So now we're looking at the topics before year test 1. And this is where it's gonna come in, what I've just explained. But now you've already done the plan, you've already got the strategy, you've already got the materiality. Now you arrive at the client. Now you are executing this plan. But you are in the planning phase of the audit, not in the planning phase of how we are going to do the audit. You are now in the planning phase where you are going to determine how are we going to start that auditing thing that we're doing. And the first thing that you do, and this is why it's called RAPS, Risk Assessment Procedures. And already I can tell you off the cuff, there are only 7 procedures that you can ever perform. No matter what you do, it's universally always been like that in audit. 7 procedures that you can ever do. So whenever they ask you for audit procedures, there's only 7 that you can give them. You will either inspect, or let me even do it from a least to highest so that you can even always apply it that way. The first thing is you will observe. And why are you observing? You're trying to identify risks. And I'm going to come back again to that very issue of the audit risk. The risk that we express the wrong opinion. And the whole thing about audit. But I just want to touch RAPS. This part, I want to touch this part. RAPS, come on. Highlight properly, there we go. Risk assessment procedures. What are you doing? You are assessing for risks. Procedures. I don't know what PS stands for, but I say it's procedures. There's only 7 that you can do. And by the way, this is Somara can hit it now. The reason we do this, the fundamental principle of auditing, remember the underlying assumption of financial statements is financial statements are created on a going concern basis and on the accrual basis, right? That's for financial statements in accounting. In auditing, we say we follow a risk-based model. What does risk-based model mean? It means that we want to identify, for the sake of expressing our opinion, we want to identify what are the areas that are likely to have material misstatements. And once we identify those areas, we then do a lot more work on them. And if we are happy with those areas, then we know that our audit risk has decreased. The risk that we expressed the wrong opinion has decreased. Because we are following the risk-based model. We are eliminating all the risks. Once you've eliminated all the risks, then you can certify those financial statements as free from material misstatements. I don't know if you've learned the different audit opinions, what we actually call them, but for now, it's good enough that you know that all we're trying to do is identify risks, do work on those risks, and then say, after we have done this checklist, we can say that the financial statements are free from material misstatements. Your sister is a doctor. Sorry if I'm embarrassing you to the public. This is where the doctor does their diagnosis. So you go to the doctor and you say, I'm not feeling well. And the doctor says, what's wrong? And you say, I don't know. And then they start doing risk assessment procedures. They start eliminating things that if these things are the problem, oh, then you're in trouble. So they go through a list of things. So they first go through the respiratory factors. Can you breathe well? Well, if you can breathe well, then we know we're on the right track. Oxygen can flow throughout your body because without oxygen, you die. That's a risk assessment procedure. So that is why they will take that doctor thing. Do I have it in here? I'm so dramatic, I'm capable of having it. I don't have it here. And then they will listen to your chest. They're trying to check your breathing. And from your breathing, they can hear. Are you struggling to breathe because there's fluids in your lungs? If there's fluids in your lungs, when you go, what they hear on that thing is meaning that there's a liquid in your lungs. That's a risk assessment procedure. If you're not breathing well because your throat has got something in it, they will hear. Then they will know that there's something wrong with your respiratory tract. Those are risk assessment procedures. You do exactly the same thing when you get to an auditee. Because at the end of the day, just like the doctor has to say, you are free from illnesses that can kill you. You want to say to the readers of the financial statements, these financial statements are free from material misstatements. They are free from errors that can kill you if you lend them money back. They are free from errors that will lead to you not having a job, employee. They are free from material misstatements that will end up with you losing your money, investor. And the way you do that, you do risk assessment procedures. As I said, the first one that you can do is observe. And I said, this is the weakest. We're going from weakest to strongest. You observe. What does observe mean? You go to Pick and Pay and you just look at everybody. And then you say, I'm happy. Pick and Pay is a good operating company. The reason we say it's the weakest is because you don't even know what you're observing sometimes. So how can you say just based on looking at the employees that the financial statements are misstated or not? If you go to dispatch, they will have been told that the auditor is coming. So when you get there and you observe, of course, they will be doing their job correctly. So you already know as a risk assessment procedure, that is very weak. That is why whenever you use observe, you must always add to it inquiry. Go to the cashier and ask them, what are you doing? This did, this scanning, what are you doing? And the cashier must tell you that I am actually scanning this item so that it can show that it was sold. Then now you know that, oh, okay, inventory is decreasing. So you observed the process and then you inquired with the staff member. Inquiry is one that you're going to use with a lot of the procedures. But I put it here because you are learning these procedures one by one. So you observe, that's the weakest. So now you observe and inquire. Now in your test, if you write, I observed this process being done, and then I inquired as to what they were doing. The examiner gives you a mark, 2 marks for doing 2 procedures. Students say it's difficult to come up with audit procedures for 14 marks, for 20 marks. What am I gonna write? Well, you observe and then you inquired. That's 2 procedures, that's 2 marks. A bonus mark for writing it correctly. Observe the store clerk for this. Inquire with them if they are doing this correctly. Bonus mark. If you just say, I observed and I inquired. Observed what? And remember, we deal with documents, we deal with people, we deal with processes. So you observe processes being performed. You observed people doing their work, but even better, you inquire from people. So you observe processes and you inquire from people. Then that takes us to the third one, inspect. What do you inspect? You inspect documents. That's the third procedure. You inspect documents. And again, inquire, you're always going to use with all of them. But before I go to inquire, always make sure, and this is where you lose marks. You don't just say, I inspect the invoice. Let me know, what are you inspecting it for? I inspect it for the date to make sure that it was recorded before year end. I inspect it for the signature, for acknowledgement of receipt or acknowledgement of review. And that gives you a full mark. You can inquire if you want to. Inquire from the CFO whose signature was here. CFO, what are you buying here? And then he says, but as you can see, we're buying a printer. And then you can say, I inspected invoice number 32, dated this, for the signature of the CFO for authorization to buy a printer. I inquired from the CFO as to what invoice 32 related to, and she correctly said that we were buying a printer. Because it's under risk assessment procedures, if she cannot corroborate that that is her signature, then you know that there was an unauthorized purchase of a printer, because we are doing risk assessments. So inspect is the next one, is the thing. Then you reperform. Reperform, as I say, if you haven't audited, it's a bit more difficult, but reperform says, I observed the staff doing this, and then I reperformed it. Why? Because you want to check, can I also do it and get the same result? So that if it is reperformable, you know that these controls are functioning as they should. And I saw that was your test for CV2, so I'm already giving away some of the stuff. The next one is recalculate. Inspect and recalculate are probably your strongest procedures, as well as inquiry with them. You never inquire alone. You never observe, just observe. You inspect documents for this, then you inquire. You reperform, and then you follow up. And this is where I'm gonna be giving you extra procedures, follow up. Yours might end with these 5: observe, inquire, inspect, reperform, recalculate. I'm gonna add follow up on differences. Because if there's a difference between what you got and what management got, they should be able to explain to you why there's a difference. And then one that I don't know if you've been exposed to yet, but it's still gonna come, you obtain a management representation letter asserting whatever you want to assert the completeness of inventory. These are higher grade marks, but that's why you're gonna get them, because you watch this and you listen to this. These are the only audit procedures that you can ever perform. You can observe, you can inquire, you can inspect, you can re-perform, you can recalculate, you can follow up, and then you can obtain a management rep letter. Now, all you have to do in your scenario is literally try and identify, what can I do to this? Okay, they tell you that this is a system description for inventory. Yes, okay. The store clerk collects the inventory. Oh, there we go. First thing, collects. What can I do? I can observe them collect the inventory. I can inquire as to what are they doing. And signs a goods received note. What can I do? I can inspect the signed goods received note for proof of receipt by the clerk. I can inquire with management or with the clerk, whose signature is this? I can inquire, what's the date that these things were in? I inspect it and then I inquire. Then you know, you've got your marks. You've just performed audit procedures for inventory of the system description of inventory. That's reps. And the reason why we add fraud and error, I don't know if you've looked at the ISAs yet, but ISA 240 says we must perform specific procedures for fraud versus error. And what's the difference between fraud and error? It's exactly the same thing. The only difference between fraud and error is intention. And that is why when you do your pre-engagement, you want to check the integrity of management. When you're doing your risk assessment procedures, you want to check the qualifications of the staff. You want to see if they have training for staff members, because staff members that are not trained are going to perform errors. Staff members that are well trained, the error that they perform is likely to be fraud, because there is no way with your level of education, with your years of experience, you can make this mistake. Therefore, it must have been intentional. So when it comes to fraud and error, what you're looking for is intention. Now, when you read your background story, they tell you that there is a lot of pressure on management to perform, to create, to report good financial statements or good profit numbers. Now you can see for your risk assessments of a risk at overall material financial statement, there is a fraud risk that management may manipulate financial statements in order to get bonuses. Or because last year they made losses, this year they want to make profits. And that will be an intentional error. And that is why it's a risk of fraud. But then when you see that, oh my God, intangible assets has just come in, and it's intangible assets that we are developing internally. I don't know if you have done IAS 38 yet, but I'm going to take the risk that you have. In the event that you have, you know that paragraph 56 has got that hectic criteria that says you must check if it has passed the technical and feasible as well as economic feasibility tests for a prototype that works, and it is realistic that management is going to procure it or build that item. That's intangible assets, internally generated intangible assets. That's IAS 38. Now, you knowing that it's complicated, you can already identify during the reading of the case study that in an overall financial statement, this is a business that deals with very complex IFRS. Therefore, there is a risk of error there is a risk that staff will make errors. And that's the difference between fraud and error. And that is why when you do that heading at the top, you can even write at the top. I think that's the exam technique that we were taught. Risk of material misstatement is increased due, there is a risk of material misstatement due to fraud as a result of. Now, exam technique again, tell them that the risk is increased because of this. When you see that they've got a board that complies with King, say that the risk of fraud is decreased because the board is accurately constituted. And that's how you know your fraud risk goes down. When you see that there's training, say the risk of material misstatement due to error has decreased because staff get training. And that deals with risk assessment procedures, as well as why we differentiate between fraud and error, the intention. And this is what takes me to ISA 315, obtaining an understanding of the entity system of internal controls. This is also understanding the entity's environment. The reason we do this exercise of understanding the environment is so that we can start being able to pick up where there are risks due to error, due to fraud, due to error, due to fraud. That is why when it comes to assessing the risk of material misstatement here at the end, I'm not skipping these two. I think you will be comfortable with these. A computerized environment just says, because there is computers involved, let's pay extra attention when we are understanding our systems of internal control. So for example, if revenue passes through that machine at ShopRite, remember computerized systems and computerized environments, there are 3 stages that the transaction will take. It's inputs, and normally that involves people, that involves documents, that involves processes. You perform exactly the same procedures as you would have performed under a manual system. You still inspect that documents were signed. You still reperform calculations to make sure that invoices add up to the amount that is about to be inputted onto the system. You still do those general controls. General controls is the same as overall internal control environment. That umbrella that they taught you guys, general controls in the audit system is it. Access controls. Access controls helps with safeguarding of assets. They speak to each other. And then you get to the point where you now assess the risk of material misstatement at financial statement level. And you say the risk is high or the risk is low. So now we've even covered your scope up to CV2. The reason I'm rushing is so that we get to risk of material misstatement at assertion level, because I know that's the one that you guys normally struggle with, and I want to deal with it. I spent a lot of time on planning and risk assessment, and that is because that's the language of audit. That's the tool that you are being dealt with. That's the tool that you use when you arrive at a new set of financial statements. If you do this step wrong, the audit is going to have a bad opinion because you failed to identify risks. You failed to follow the risk-based model. You fail to put in enough controls or enough procedures to make sure that you do not give the wrong audit opinion. So you assess the risk of material misstatement at financial statement level. So you look at your errors, you see the ones that increase, you see the ones that decrease. Even use arrows in your exam. You will get marks for those. Increase due to the following, decrease due to the following, increase due to the following. And at the end, you count 1, 2, 3, 4, 5, 6, 1, 2, 3, 4, 5. And then you say, oh, I've got 10 that increase and 6 that decrease. And then you assess the risk of material misstatement at financial statement level is low or is high or is medium. Because now that you've gone through the whole process of identifying the environment, you can now tell that when I grab these financial statements, before I've even looked at one invoice, just by looking at the culture, inspecting if documents get signed, inquiring if people know their work, we can already tell that the risk at overall level is high or low. And the golden rule in auditing is that there are many golden rules, by the way, but one of them is that if an entity as if an entity's general controls cannot be relied on, we do not even test the application controls. Or we do not even rely on that environment. We do not rely on test of controls. What does that mean? If these guys are not scanning every item that goes through the printer, we're not even going to worry about observing that process. We are just going to go straight to the financial statements and say, give me all of the invoices, all of the sales records. We're going to go to the storeroom, say, give me all of the goods received notes. Are they all signed? Now we go to the financial statements and say, show me all the invoices that pertain to these invoices, to this inventory. Have they been paid? Yes, no. Then you've done your completeness. This inventory item, show it to me under thing on the stock count sheet. And that essentially is going to deal with each system and write them down. You've got, I think, 5 systems. You've got revenue and receipts. You've got expenditures, got expenditure and payables. I think you had one for assets, you had one for bank and cash. When we say cram them, because you have not been in an audit environment, we are saying for the sake of the exam, just know that your company must have this environment in place. And when we add computers, they must have these systems in place. Now we go to assertion level. I'm going to try and take 5 minutes with this or 10 minutes. Obviously, you know me by now that that's probably a lie, but I'm going to try wrap this up here because up to here, this is what your exam is on. Just last one as I go there, right? You see here, determine an overall response to the risk of financial statements and assertion level. This overall, I see you did a project workshop. I can already tell you now, if you write this one, you already have a mark. Get more experienced staff on the audit. Why? Because now that we have seen that management does not have integrity, now that we have seen that they deal with complex financial statements, financial items, now that we have seen that the internal controls are not reliable, you want audit members that are going to be experienced. You want us, people that have been auditing for 5 years, 10 years, 8 years, and not somebody who's new. Because somebody who's new is not going to be able to see that this is not the signature of the CEO or the CFO. This is a forged signature. So you get someone with experience, not an expert, someone that with experience in auditing. And all the others, regular reviews. You review their work continuously. Have regular team discussions so that if I pick up something under inventory, we already know that it affects cost of sales. So I'm auditing assets. The person that's auditing cost of sales under expenditure must know that under inventory, I am getting unsigned delivery notes, meaning that there might be fictitious sales or the sales or the cost of sales might not be as high. That is an overall response, just to make sure that we do not express the wrong opinion, that they're not committing fraud or errors, and we are not able to pick it up. We are the last line of defense before the banks, before the shareholders, before the trade unions. Have a look at those overall responses at financial statement level. There's 8 of them. The minute they say determine an overall response, write all 8 and move on. You will always get your marks. Maybe they will limit it to 5 because they know that It's unlikely that students will remember all 8. So then 5. 5 is good enough. Now we go to assertion levels. This seems more difficult, but all that assertion level means, and this is auditing for the rest of your life. Auditing happens at assertion level. All that we're saying at assertion level and identifying risks of misstatement at assertion level. We have given you 2 sets of assertions that exist. Assertions for transactions and assertions for account balances. You cram them. But if you don't want to cram them, then here's an easy way to think about it. A transaction is a movement, it's a flow. It's not at a point in time. I've got wavy lines here. That's transactions. Therefore, the only way that management can assert that particular thing, the only way management can say for sure that the number that we have put in the financial statements is correct is if the following are met. If there's a cutoff, first of all. I don't know, there's not a day that you've gone to ShopRite and they say today ShopRite is closed because we are busy with financial statements. ShopRite operates 365. Maybe on public holidays they operate for half the day, but they are open, they are operating throughout. So then you as the auditor need to have a cutoff to say, let me see revenue. If transactions that happened at 23:59 on the 31st of December were recorded in this year, and transactions that happened at 12 o'clock and 1 second on the 1st of Jan, if they happened in the following year. And those transactions can be purchases. They can be, you have to see that this is a transaction. This is not at a point in time. And the way we know it's a transaction, it's the financial state, it's the statement of financial performance for the period ended. Then we know that we are dealing with an assertion level statement. So if it's wages, salaries and wages, you know we are dealing with transaction assertions. I'm going to leave completeness for last because it's on both. Then you've got classification. We purchase inventory, but if it's not sold, it goes under inventory, not under cost of sales. So that's why classification is important. Accuracy. There's 15,000 transactions going past. We need to assert that it is accurate. The total that we're going to evaluate under what happens 15,000 times. I'll go for revenue again. We want to know that that amount is accurate. And what makes an item accurate? It's quantity times rand amount. Occurrence. Did this even happen? Did this even happen? Occurrence, you know, you want to see an invoice with the entity name. You want to see a signature. And you want to see a date. And you know that these transactions pertain to the entity. The transactions happens at Checkers. ShopRite and Checkers are one family. So the sale definitely happened, but Do we have rights to it? Does it belong to ShopRite? And that's where occurrence comes in. And then completeness. Completeness, we say, is from bottom up, not top down. So all of these other assertions, you are going to request source documents. So you're going to look at the line item on the income statement, and then you're going to say, give me these source documents. Completeness is the only one where you are going to select the source document and say, show me this item on the financial statements. Then that way you know that you have covered your financial statements. Your financial statements are complete, they're accurate, they're whatever. In auditing, we actually start with completeness, because if an amount is not complete, it cannot be accurate. If there are 10 invoices that are not inside the revenue amount, then revenue cannot be accurate. That's why we start with completeness. And we select a sample. You can remember, you get marks for this. Select a sample of invoices. And they want to see, versus select a sample of transactions that make up the revenue amount. All other assertions, you're going to select transactions. For completeness, you're going to select invoices. You're going to select the source document. And then what do? You are checking. In both instances, you are checking, does the general ledger show what's on the invoice? And for completeness, is what's on the invoice showing what's in the general ledger, or the trial balance, or the financial statements? Because we express an opinion on the financial statements. And that's what at assertion level is. And the reason it's even a bit fuzzy for now is because a lot of our items, remember in accounting, we have what we call a balance sheet approach to accounting, i.e., we have become so comfortable with the income statement that we say a lot of the transactions actually are happening from the balance sheet going that way. That's why your revenue, your accounting standards, most of them, if you ever look at them, they're balance sheet standards. It's probably only IFRS 15 that is an actual income statement item, revenue received from contracts. Everything else, leases, inventory, you name it, they're all balance sheet items. And that is what we mean at assertion level. That's where it becomes important to then know existence. So if we deal with many small inventory items, we say existence is high, because if we move it from one place to another, you wouldn't know. Valuation is a very popular one. Valuation and allocation. Why? Because your entire IFRS is based on how to value items. Your entire IFRS, the whole IFRS, is valuation and allocation. Did you account for depreciation correctly? Did you take impairment to the correct account? Did you take reversal of impairment to the correct account? That's what we want to see. These affect the valuation of your PPE, but they also affect the allocation of the contra account. Did you show it under OCI? Did you show it under profit and loss? And that is why I said to you at the beginning that if you study your accounting and perfect it, auditing then just becomes a tool. Now you hold your accounting, your accounting solution like this, and then you take the assertions. You say, what is this? This is an account balance. Then you take it through the auditing assertions. Existence. How do you test the existence of a lease? Well, number one, it's on paper. But number two, you actually would go and confirm, does the actual building that they say we leased here exist? You check the address and you go and corroborate the address. Valuation of a lease, that present value of future lease payments, did they use the effective interest rate or did they use the borrowing rate? That's auditing when you ask those questions. But you did it in accounting. The N, did we take into account variable factors towards extension of the lease or not. That's accounting, that's IFRS. The better you know that, in auditing, when you say you identify the risk of material misstatement at a certain level, the minute you see leases, you then start, you write down existence. There is a risk that the lease may not exist as the building is rented and therefore whatever. Perhaps leases affect rights and obligations more because there is a risk. If you check leases, I think it's paragraph 23, where they speak about control, your ability to access the premises, your ability to determine the variability and extent to which you can use the building. Can they stop you from entry, that sort of thing? You assess. There is a risk that we do not have rights to the lease because the lease agreement is so restrictive. And those are your assertions at assertion. That's your risk of material misstatement at assertion level. And you write that for the examiner, that there is an increased risk at assertion level of existence because this is a movable asset. There is an increased risk of valuation because this is a building measured at revalued amount. And there was a there was an impairment, and then there was a reversal of impairment. What is a reversal of impairment? A building burns down in January. In July, they fix up the building. In December, you need to identify that the carrying amount that we had at the opening at the beginning of Jan was this. It then got impaired because the fire burnt it down. It then got fixed by the insurance, which means that it got reverse impaired. And at the end of the year, we used it for the remaining 3 months. So there's depreciation, and therefore there is this much of the building that is still represented by the carrying amount that is in the financial statements. And all of that, you look at it and you think this is complex. And then you write there is a risk of material misstatement at a certain level on the valuation of leases, of the valuation of buildings because of this and this. The accountant is very well trained in leases. Therefore, there is a reduction at a certain level when it comes to the valuation of leases. The leases are reviewed. We inspected the board minutes and they said they review the lease, whatever, every quarter, the lease terms every quarter. And you inspect those minutes and you see that they actually did review the lease thing. Then you say in your risk assessment that the risk that leases, that we've got rights to lease in our leases is reduced because every year or every quarter, the board goes through the lease terms and the lease contracts. And by doing that, you have just audited. And when they say determine a response to the risk at a certain level, if you determine that the risk is high, what are you going to do? And that's where nature timing extent comes in. At the beginning of the year, at interim, we are going to collect the thing. So if there was a fire in January, in June, July, there were repairs. And then in December, we are now coming to audit in December. But remember, we did the audit plan at the beginning of the year or at the beginning of the audit. So this is next year, January. We're auditing last year's financials, January to December. You are now coming in as the auditor in February. And now you're placed on this audit and you get told this long story. And now we say, how do you respond to the risks at a certain level? You say, for valuation, I would have done an interim audit because by interim, we at least could have checked, was it impaired? And if they had finished with the renovations by interim, we could have even already checked the renovations there. So we could have checked the reverse impairment. And then come end of the year, we just need to audit the depreciation, because that one would have been, the rest of the transaction would have been audited at interim. And that's all that auditing is. It's a lot now because you're studying it. It's a lot now because you're an undergrad and you're learning it. But you will see that this is all there is to it. Let me look at your second semester. It's going to be actually performing the work and then concluding and writing a report. Therefore, we express an unqualified audit opinion. The financial statements are in good order. We are happy. But the planning phase of the audit, this is where we are saying that we are applying the risk-based model. The way that they taught me in audit, in practice, was they sat down with me and they said, Sechi, I need you to assume that these financial statements are misstated. Now in planning, what are the items that are going to show you that we should have known that the financial statements are misstated? And that is what they call the risk factors. That's what they call the risk. So what is a risk factor? I saw an employee go home with a tin of beans. That is a risk factor. What is the risk? The risk is that inventory may be overstated because we would not be able to pick up that a tin of beans has left the building. That's what they taught me when I was in my, I think, second year. They should have taught me in first year that this is all that we're doing in the planning phase of the audit. We're just observing and inspecting here and there, but we're not inspecting with the aim of proving. We're inspecting with the aim of seeing what is the likelihood that these things are not being performed, and therefore our financial statements are going to be misstated. Let me know after you watch this video if this makes auditing a lot simpler. And if that also helps you with your accounting, it shows you that you need to know your standards, not even off by heart. You need to know how to process transactions and be comfortable that every transaction that you consider in accounting, I would say tax and financial management as well, you are able to also sit back and say, if I were to audit this, this is how I would do it. I would request the invoice. I would request the purchase agreement. In standard costing, which you haven't spoken about this year, you would say, I would request the production report. I would request the labor register. I would request the material report. How do you audit abnormal losses? You ask for the production report. You ask for the inventory, closing inventory. You ask for work in progress. You ask for raw materials. You do an audit of that, and then you see that there is a lot of items missing here. There is a huge variance under financial management when doing standard costing. Now you know for audit that variance indicates that there is a risk that inventory is understated or overstated. I'm going to end it here because you know I can talk forever. Thanks a lot, Junior. All the best. You can do this and you will do this. Trust me. You will do this. It's very doable. Auditing is one of those subjects that once you can speak the language of saying inspect, observe, reperform, recalculate, follow up, your marks start to shoot up. Your marks start to shoot up. Now it becomes difficult to get below 60 because the minute they give you a risk assessment or they give you you immediately write. I would observe, I would inquire, I would inspect, I would corroborate, I would follow up, I would require, I would inspect, I would follow up. And then at the end you say, I would obtain. At a certain level, very important, at assertion level, obtain management representation letter that the existence of property, plant and equipment has been made. Normally, because management representation letter is 1 mark, they will give you up to 3 for stating all of the assertions correctly. So you will say, obtain the management representation letter as at, because the balance sheet is at a point in time, as at the 31st of December, that PPE existed, was valued, we have rights to it, and is complete. And then the presentation and disclosure assertions as well. Have a good practice. I know you're going to kill these exams. Don't aim to kill them. Just aim to get the easy marks. Get the easy marks, and you will see the marks will accumulate as you're busy collecting them. Thanks a lot, Junior.